I think a lot of people made money in the last few years and now they think they're good at investing.
Those aren't always the same thing.
Yeah, because if the only strategy was buy it and pray it goes up, that's not strategy, that's vibes with a closing cost.
And the problem is that works until it doesn't.
Right, and when it doesn't, there's a certain type of person who shows up, not surprised, not scrambling, just ready.
And today's guest is one of those people.
8, 7, 6, 5, 4, 3, 2, 1.
Welcome back to Commercially Speaking, where we break down investing, business, and brokerage so you can make smarter decisions, protect your capital, and understand what's actually happening beneath the surface of a deal.
Because apparently, it feels like a good deal is not due diligence.
Today, we're joined by the CFO and co-founder of Aspen Funds, a firm that focuses on alternative investments, distressed debt, and building portfolios designed to hold up when the market gets uncomfortable.
Which feels like where we might be headed.
His approach flips traditional investing. Instead of chasing upside, he starts by asking where things break and builds from there.
So today we're getting into why most deals don't fail, they just never get funded, where capital raising actually falls apart, and what separates the groups that consistently raise money from the ones that are stuck pitching forever.
We're also unpacking what's really happening in distressed deals and what investors should actually be paying attention to right now.
Basically, if your current strategy is, I think this will work, this episode might lovingly ruin that. So without further ado, investors, operators, and people currently in the deal they hope works.
From the world of capital strategy, risk management, and disciplined investing,
The man who doesn't chase deals, he dissects them.
the man who doesn't start with upside, he starts with survival.
Yes, the author of Invest Like a Billionaire, please welcome Fraser.
Hey,
All right, I can't wait.
Bob, welcome to the show.
Yeah, this is going to be fun.
Yeah, good. Bob, let's start out. I ask the same question to everybody that comes on. Will you introduce yourself? Give us like a 5-minute origin story just so we can get a little background on where you came from and how you got to where you are now.
Sure. Yeah. Well, I'm a complete nerd. UC Berkeley computer science graduate. Okay, top of my class, and I worked as a computer programmer for 15 years.
Wow.
And that's all. So I was a complete nerd, heads down coder. Absolutely loved it. And then got an itch and decided, I had kind of have an entrepreneurial itch. Started at .com in the mid '90s, and it blew up. Became the largest venture capitalized company in the Midwest United States.
Wow.
It grew it up to 300 employees. With the fastest growing company in the Midwest United States during the late '90s, and then lost everything in the .com crash. And yeah, but what happened is I got a financial education at that time, and kind of a business education. I was not a businessman. I was not a finance guy, and I became that. And out of that, the next gig was kind of doing public markets trading, and started to become a quant trader using systems, et cetera. And I got creamed in the great financial crisis. Second time wiped out by the public markets. And after that, I'm like, forget the public markets, right? I'm done with this because it's just completely, you just can't control anything, right? It takes you for a ride wherever you want to go and where you don't want to go sometimes. And then I started thinking about alternatives, right? I'm thinking about in the great financial crisis, all these, the housing that crashed, but I don't know, any houses actually vaporized, right? They're still there and they're still valuable. And so I started looking into alternatives and kind of retrained myself in that, and then started Aspen, which is kind of an alts firm, and then wrote this book, Invest Like a Billionaire, to really help investors do better. As so many investors are not doing a good job, and their financial advisors are not helping them, and are not helping them do what the biggest, smartest investments are investors are doing. And so I wrote this book. It really is as a passion project to help the little guy do great at investing and become a fantastic investor.
You just mentioned a couple almost shorthand. You said quants. You said used another term, and I forget what it was. The only reason I know what a quant is from the show Billions.
Mm.
Did you watch the show Billions?
No, you reference it a lot, and I love Paul Giamatti.
Yeah, he's fantastic in that show.
Yeah.
But and here's my understanding of what a quant is. It's basically somebody who is just and this is from the show, completely data driven, and they're just trying to triage the market and move faster than everybody and make like super fast trades with
Mm.
data that captures the spread over and over and over and over and over again. Like, is
Yeah.
that even accurate?
Yeah, the first part is right. It's data driven. It's using mathematical models and anomalies to trade the market. It doesn't have to speed doesn't have to be an element, but
Okay.
it is using math to drive. You're analyzing the market and doing math. And I'm a math guy and a computer guy, so that fits me.
Yeah. You also sound a lot like my two daughters. It sounds like you like playing with bubbles, which gives you which is what gave you quite the education. um, what you know? What's something that you think investors believe right now that you think is wrong?
Yeah. Well, okay, I'll give you an example. My daughter, who's some 30 years old, knows I'm into alts and all this, and I'm trading alts. She says, "Dad, I just invested in Nvidia, and it's like I'm making so much money in Nvidia. Why would I pay any attention to anything else?" And I
Yeah.
said, "Yeah, that's exactly why. Because it's gone up so much. Do you think it goes up forever? Does something go hyperbolic forever? Absolutely not. Every bubble ends the same way, right? And this feels a lot like the dot-com bubble, and if it is absolutely revolutionary technology. It absolutely is gonna change everything just like the internet and just like the internet revolution, but a good technology does not make a good investment.
Hmm.
And so that's completely different, right? Airplanes are a great technology. They've been a lousy investment since forever, right? So we have to differentiate, and because something has gone up doesn't mean it's going to continue to go up, right? Everything goes up until it doesn't, and as soon as what happens when everybody who is bullish has bought? Well, then there's no one left to buy, and if there's no one left to buy, you only have sellers, and then it goes down, and that's why the market cycles. And I've done just a little quant analysis, and if you look at the price to earnings ratio, which is the priciness of stocks relative to the earning power of stocks, right now it's in nosebleed section higher than the dot-com bubble, and history tells us you can mark the stock market from any point in history and look at the PE ratio at the time, and look at the how it performed over the next 10 years. And based on that, right now we should expect the next 10 years to be about a 0 or a minus 0.1% return for the stock market. So not great.
Mm-mm.
Now that's math, and that doesn't mean it's going to happen, right? But that's history.
So you mentioned alts. Now, I've been in commercial real estate since I got out of the Marine Corps in '04, so that's going on 22 years now. Commercial real estate's been my main thing. I've done a lot of different things, but it's always kind of been in that lane. And so when I hear it called an alternative investment, it annoys me, you know.
Okay.
But that's what it is. I mean, commercial real estate is an alternative investment,
Just
but
not to you.
not to me,
Yeah,
but
yeah.
like when you say alts, though, you're not just talking about commercial real estate. What are some other things that fall into that category?
Right. And the differentiation I would make is that they're professionally managed. So these are passive investments. Now you might have been done commercial as an active investment, which is really a business.
True. Yeah,
Okay.
you're right.
So what I'm talking about is where you literally are just putting money in the deal. That's it, right? That's like a public market investment or any other investment. Your contribution is entirely your money and nothing else. But to answer your question, okay, so real estate is a big alt, and it's awesome. Private real estate. Another one is private credit, which you know a lot in the news right now, but we absolutely love private credit. Private credit has a superpower, and it's called low risk, and high cash flows plus liquidity. So you actually have alts that can get double digit returns sometimes, that gives you monthly cash flow, and that is fairly safe, and even safer than commercial real estate, for instance, and also has liquidity, which is the big bugaboo about alts, right? That your money's tied up. So
Right.
it has a superpower. Then there's natural resources things like oil and gas, et cetera. That's the largest kind of category of natural resources. Its superpower is being the most uncorrelated of all the assets. So when everything else is zigging, this thing's zagging, right? And you need that. You want things that are zigging when everything is zagging. It's highly uncorrelated, and you can see that happening now as the stock market is just doing these gyrations, and oil and gas is holding fairly steady and going up. Then you've got private equity, which is kind of the granddaddy of private alts and has, I mean, 50, 60 years of
Mhm.
outperformance. Um, you got hedge funds and venture capital as some big areas as well. And there's a few others, infrastructure and gold and cryptos and other things, but those are the big ones.
Yeah. So can we go back to private credit for a second? Like
Absolutely.
what is that? Is that when I hear that I think of like personal loans and is that am I even close?
No, no.
Okay.
So generally, private credit, the big category of private credit is it's generally when you make loans. These are
Mhm.
non-banks making loans to organizations. The biggest category is they're making loans to private equity firms. Okay, that's the biggest category. Now we have two private credit funds. One of them it buys mortgages. We have 1,000 residential mortgages in the portfolio. Okay, it's awesome. Then we have a second it makes loans to commercial real estate. So if you're going to buy a piece of real estate, you may want a mezzanine debt, right? You may want some pref equity. And, Bo probably knows what that is, preferred equity, right? So we would offer those and we're charging 15 points ish. So we make our fees, we pay our costs, and we're giving investors double digits. But we have all these loans, they're short-term loans, right? So maybe they're 2 or 3 years in maturity. So we have all this cash flow, right? They pay off all the time. So if when
Mhm.
investors want their money back, we have no problem having liquidity provisions. It's not as liquid as you can't sell it today, but we have 4 liquidity windows a year. So in any quarter, you can get your money back. And it's very safe because this is below equity, right? We're above the senior in most cases, but below the equity. So we're well placed in the capital stack.
So most of the people that invest or invest into the fund, they are all right. I'm gonna try to impress you, Bo.
Okay.
Okay,
Yeah.
because you got accredited investors,
Uh-huh.
right? So they either need $1 million in assets, but or worth $1 million
Net worth
net
outside
worth
of
of
their home.
outside of their home, or they make 200,000 a year, 300,000 as a combined couple mainly, or they've got a certification or
Yep.
something like that. And so you've got those are accredited investors. That's who you are typically looking for, correct?
Correct.
Or
Yeah.
yeah, okay.
The
So which
certification,
means
by the way, is more on the sophisticated side. So that
okay.
you just got to be a certain amount of wealthy to be accredited.
Yeah, yeah,
Correct.
right. So you are dealing with Reg D 506 Cs.
That's correct.
Huh?
Come on.
Huh?
Okay, I'm officially impressed.
Okay, good.
Well done.
Okay, right. So just so everyone listening that doesn't understand that, okay, these are deals that you are able to advertise or market, you're able to put out there. And if somebody is accredited investor recognized by the SEC, you are able to invest uh, in
He can,
everything that.
yeah, he
That
can
that
technically
that's
invest.
correct. That's correct. Yeah,
Okay.
we have a mission in my firm to serve retail investors. We do not take actually institutional investors. So one of the reasons we exist is to make great alternatives for retail investors. And I'd started, we actually started in distressed debt back in the end of the great financial crisis. We started buying bad debt. We figured out how to fix it. We made a lot of money. And one of the outcomes of the bad debt was good debt when you reperform the debt. So someone who wasn't paying on their debt gets a loan modification and starts paying. And one of my friends came to me and said, "Hey, Bob, I got an inheritance." And this guy literally, I'm not joking, has 13 adopted kids, special needs kids. Okay.
Wow.
And he said, "Bob, I got a little inheritance, but I need to earn income to pay for my kids." I'm like, "Good luck." He knew I was a public markets trader and said, What can I do for income?" I said, "Good luck. There's nothing out there. Forget it." And then I went home and I thought, "You know what? We could make a hell of an income fund by buying these reperforming notes into a fund." And that was the genesis of our fund. And we started this fund 14 years ago. It's never missed a payment. It's audited. It's now $100 million dollars in equity, and he was my first investor. And so that's our mission. I want to make great alternatives for investors who need these kind of products, right?
Yeah. What are people misunderstanding about this space? Because when I hear this, I can see a group of people being like, "You're coming in, you're buying a distressed debt." I'm not going to say anymore. Um, it's yeah. What are people misunderstanding about this space?
I think people feel like alternatives are risky, and it goes like this. When we first were coming out of the gate with this fund, we're so excited. We designed a very nice fund, a lot of robustness built in it. I can explain why. We did the thing. We hired a company to fill 50 butts in chairs and accredited butts and in a restaurant, and we paid for a steak dinner for people, and they agreed to listen to our pitch, and they were qualified, and it happened. They put 50 people who were qualified accredited investors in a seat. We bought them a steak dinner and we made our pitch. And to a person, every single one of them said, "This is insane. This is awesome. This is exactly what I need. This is great." The second thing they said was, "Let me bounce this off my financial advisor."
Oh, yeah.
And
Mm,
or they said, "Gosh, this is so great, but let me find a financial advisor so that I can ask them about this." And guess how many investors we got from two of those events at 100, you know?
Yeah, I'm thinking 2,
0.
0? Yeah.
zero.
0. And so what happens, as soon as you take it to a financial advisor who are very conflicted, by the way, and the second chapter in my book, Invest Like a Billionaire, is 7 things your financial advisor is not gonna tell you. And I
Mm,
believe in financial advisors. They serve a valuable need, but they do not understand alternatives.
mm,
Very, very few do. And literally, it's not a part of their database or their knowledge base. It just isn't. That's not required to do their tests, and they really are ignorant. But what happens is they facilitate, or they foster this fear that alts are kinda wingnutty, they're kinda edgy, they're fringy, and they're super risky. And they certainly can be, right? You can make some really stupid investments in alts, but there's some really good ones. And, so, you know but then that's the same in a public company, right? I've invested in some real stinkers in the public
right.
companies, right?
Sure.
And where
Yeah.
you wake up one morning and they drop 90% in value, right? The next day. It's like, so, you
Yeah.
know,
So where does it go wrong? Like, take us behind the scenes a little bit after after you get the deal and the distress deals
yeah,
specifically.
yeah.
What do you do to create value? And also, where do things go wrong?
Yeah. Where do things go wrong? And that is a great question to ask, because it's the main one of the biggest difference between billionaire investors or very sophisticated investors and less is risk focus. Right? So big investors, the first thing you want to focus on is not losing money. Right? Warren Buffett said, "The number one rule of investing is don't lose money.
Don't lose
The
money. Yeah.
number two rule is don't forget rule number one."
Yep.
Because I could show you the math, and in my book, one of the first things I do is show the math of compounding. If you have losses, you stop compounding. It stops working. And if you have a portfolio that's volatile, gets up and down, but has a higher return, but it's up and down, you actually have less money at the end of the day than if you have something that's boring and steady. And so focusing on losses matter. So it's the right question. And how do you where does it go wrong? Well, there's a lot of ways, right? This is, I put all my failures in the book, right? All the things that have gone wrong. I've made some real stinker investments, and everything from a guy who literally walked away from the alt, after he raised $50 million and then left the business when I got hard.
Oof.
To a guy who, because he was incentivized, on construction fees, overbuilt the project because he got paid on that, and did way too much and added too much risk, and now it's struggling, to, um, you know, guys that did Ponzi schemes, and so there's a lot of ways they go wrong, and it's like how many ways can a marriage go wrong, or how many ways can a business go wrong? I mean, it's just kind of legion, right? It's there's no
Yeah.
you can just list them forever.
Well, you kind of
Eh, eh,
explained it when investing in stocks, right? The ones that go up and down, the ones that are slow and steady.
yeah,
When you're picking somebody to marry, are you picking the one that's twerking all the time, or do you want the one that seems, they're ready to stand by your side?
right. There's your new motto. Don't invest in twerking stocks, right?
Yeah, it could be fun. Could be fun for a while, but you'll lose all your money. Is- sorry, I digress.
No, that was great.
Yeah,
That was great. I do have a question about your coding background because that seems like a real differentiator to you. Like, how is it different when you underwrite a deal because of your coding background versus guys like me that came up in more traditional method? I mean, like, I get into the numbers. I'm looking at the math. I'm trying to figure out the NOI and looking at what cap rates are doing and paying attention to the capital stack and all that stuff.
talk
But
about
like
nerd. You all would get along.
we probably
Yeah.
would, I'm sure. But like, how is it different based on your coding background? Because it
Yeah,
seems like that's somewhat of a superpower of yours.
Mm,
yeah. I think it's a very, very logical and very sequential, right? I mean, it's very systematized what I do, and a code, code is building a system. And so we build systems that are repeatable and that measure the same factors over and over and over. And so I would say it's definitely helped us, but I think too my experience in the public markets and having 2 large craters in my history has made me think differently than all these young bucks out here building investments. I literally know any day there could be a cliff in front of me. And so I'm building my investments to be bulletproof, and that's of course impossible, but I'm doing my best to make sure there's a plan B and a plan C and a plan D that's a secret plan. No one knows about these plans, just me. But I've got a plan that if things really go off the rails, I know what to do and how to rescue my investors, right? And how to make this work because I promise you there's going to be another crisis, and I can't tell you what it's gonna be. There's always another crisis. The only thing that's sure about the next crisis is it won't be like either of the last 2, right? Or the last 3. It will be completely different than the last 2 or 3, but it'll be a crisis. And so you really need to be bulletproof, and I think having gray hair and having a lot of scars has helped us be more conservative and to take only very measured risks. And by the way, the computing background helps that, right? Again,
Sure.
very methodical.
We had a previous guest on. His name's Bob Knackel. He's one of the most successful brokers in the history of New York City. And one of the things he always said, which is sort of the other side of the coin of what you just said, like you just said, there's always another cliff. There's always another downturn coming. There's always another crisis that's going to happen. His thought is at the end of every downturn is the next upside. So like it never stops with the cliff. There's always the upside on the after side of that. And so when you mentioned that, my thought went to, and if you really can seriously mitigate your risk during the next downturn, then you're positioned to really take advantage of the upside.
right.
He is 100% right. He is 100% right. Now, but finding the bottom, that's hard, right? And in fact, this is another difference between billionaire investors and the normal dude. Billionaire investors are not trying to predict the market. They don't care. They believe that you cannot tell where interest rates are going, where the stock market's going, what geopolitical things are gonna happen. They don't even try. I'll tell you what they do is they build a bulletproof portfolio that is resilient in all of those things. And then what happens? So let's say your portfolio, you got 5 big categories, right? One takes a major dip, it takes a dump, right? So you got a little hole in your portfolio. Well, next quarter or next year, you rebalance. And what do? You sell the stuff that's gone up when you rebalance, and you buy the stuff that's gone down. And so you're selling at the top and you're buying at the bottom. You see this? So
Mhm.
you're doing this, but you're doing it mathematically. You're not doing it emotionally. You're not saying, "Oh, man," So I told you I was a public markets trader.
Mhm.
My number one indicator of tops and bottoms, you know what it was? My blessed mother. So my mother was one of my investors, and she would call me and say, "Bob, sell everything. It's all going down. It's only going down. Sell everything right now." And I would say, "Mom, thank you so much." And I would back up the truck and start buying.
Yeah. Yeah, yeah,
A
yeah.
and then she would call me and say, "Bob, buy, 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 buy. Oh my gosh, I'm so excited about the market. Buy, buy, buy." I would say, "Mom, thank you so much." And I would sell everything. And she was the best indicator ever. And it shows what investors do. The markets are designed to psychologically trick you, and we end up making the wrong decisions. And so the whole point about what billionaires do is they're methodical, right? They build portfolios. They construct a perfect, really well designed portfolios, and they let them ride, right? And then they rebalance. And it's the right way to do these things.
What do you look at first when evaluating a deal?
Yeah, and I go through some of these in the book, but there's a lot of things you look at. Certainly in real estate, you want to look at leverage, and leverage is a very big deal. The number one, if you want a shorthand, like a shortcut, the man's cheapest way to get pretty much 80% of the value out of due diligence it's called co-investment. How much skin does your sponsor have in their own deal? How
Mm,
much skin in the game? So all these deals, real estate deals, preferred equity, all these other things, right? All of them have what's called promote or carried interest, right? Which means the sponsor shares the upside with you, and they're aligned with you on the upside, right?
mhm,
So
okay.
if you make money, they make money, and if you make more money, they make more money. What they're not aligned is on the downside, which we just said is the most important thing: risk. They're not aligned. So they're actually incentivized. And I had a guy do this. I had one of my sponsors do this. We said under no circumstances, it was a construction deal, build phase two. Under no circumstances, build phase two. It's too risky. We don't have the market data for it. He went and built phase two. And because he got construction fees. And
Oh,
he had no skin in the game. He had no dollars of his own money. He had only upside. And why? Oh, it makes sense. He gets the fees, number one, and number two, it's going for a moonshot. He's
mhm,
gonna do better if he's a moonshot, but he doesn't share the downside. So you want people that share the downside, and the best way to do that is co-investment. How much of your own dog food are you eating? And measure that, and you get pretty much everything. Because no one, us sponsors, we're pretty sophisticated, right?
mm,
And if the deal isn't good enough for me to put my money in, then why should you put your money in? And you want to make sure it's material, it's
yep.
significant. And, and
I
and by the way, my firm, every one of my partners puts in materially in every deal we do.
I
We're about to launch our 3rd fund. We've got a, fund. This is gonna be the first time we've done an evergreen kinda permanent capital model where we're doubling down on compounding and,
Nice. I love
really
evergreen
excited about it.
models, by the way.
I'm really glad to hear you say that. Really glad.
I'll tell you why when you're done.
But one of the things we're trying to figure out right now is what is material? Because one of our big selling points is, man, our money is right in there with you. And we wanna so we're trying to kind of benchmark what's out there and try to get a feel for what is material. Because like, if I put 50 grand in the deal, like, that's a lot of money to some people, but if we're trying to raise $100 million fund, that's nothing, that's not material co-investing. But what do you see out there that like, how would you define material? Is it a percentage? Is it what
Yeah,
put a
I
number to that for
usually
me.
I usually tell our investors, the dollar amount that we're investing as a sum of all the partners, but the real materiality would be percentage of net worth, right? How much are you banking on this? How much are you backing up? I want to know how deep you are, and if you're putting 20% of your net worth in this, well, holy cow,
mhm.
then you're a believer. If you're putting 1% of your net worth, then I don't know anything about you. I don't know if you care or not. right?
I like
You're
that a
it's
lot.
a fig leaf, right, to
That's
you.
meaningful.
Mm.
Yeah.
Yeah, because it takes the variability out of, you know, if I'm worth $100 million, and I'm not, but if I was and I put in, $500,000, not much.
Yeah, that's right.
But if I'm worth $5 million
Right,
and I put in 10% of my net worth,
Yeah,
like
right.
that would be I like that. I like that a lot as a
yeah,
metric.
that's a great point.
So you
Yeah.
had you had something about permanent
Evergreen funds.
yeah.
So
Yeah.
Evergreen so a lot of people favor syndications, right? Serial syndications, right?
Mm.
Which has
Data
been my background.
shows, and
Yeah.
I can forward you the study. I don't have it in front of me, but there was a study done that showed that evergreen funds generally produce about another 1.5 to 2 percentage points of return, even at the same IRR as sequential uh, uh, syndications. And here's why. Here's a few reasons. So
Hey, wait, can I stop you real quick?
yeah.
Let me see if I can get Timmy to tell us why.
Yes.
Okay.
Okay.
What would you say?
The
Actor, comedian,
yes, the question
co-host of a commercial real
the
estate.
question the question is
The question is, if you take sequential syndications,
yes.
kind of what I've done in the past,
Right.
5, 7 year deals, we sell, everybody gets their money back, and then they invest in something else. And let's say all those average a 16% internal rate of return.
Okay.
If you have an evergreen fund
Mhm.
that same amount of time, let's say you daisy chain 3 syndications, all right? 5 years, sell, recast, 5 years, sell, recast, another 5 years, and it averages 16% internal rate of return. And then you have an evergreen fund that averages 16% internal rate of return, but it just goes that 15 years and then you exit for some reason or whatever. The evergreen fund will generally do 1 to 2% better
Yeah.
over that amount of time, even though they're averaging the same IRR or however
Sure,
that's the
sure.
metric. Why?
Well, did okay, let me okay.
Why will the evergreen fund do better?
Well, compounding, but that's not the answer you're looking for. There's not all these fees of selling and buying and like it's just sitting there and growing.
So we had a guest,
That's
right?
right.
Greg Dugard
Yeah.
came on here. He was talking about this. He said the most destructive thing you can do to wealth is what? Sell.
Sell it.
Yeah.
Yeah, because it keeps going up.
When you sell, you create taxable events,
That's
all that
right.
stuff.
That's right.
And that's why when you daisy chain those investments and just turn around and recast it, like you would have done better off just staying in the deal.
That's right.
Yeah.
So I was right.
Yeah.
You are 100% right.
Right.
100%. And even your first point of compounding is actually right.
Yeah.
And there is another reason too. So you think about it, when you do a single asset syndication, which I've done many, you have to think about how how much capital you reserve. You have to reserve for every negative contingency that could possibly happen. You have to
Yep.
over reserve, and then you're sitting on flipping cash, right? You're sitting there, and meanwhile, while you're deploying, right, you have to sit on that cash. Okay, so they're less cash efficient, but the reality is, so what happens is if you do, take a 4-year syndication, you do 5 of them over 20 years, that means you have 5 pauses. So you pull that money out, you pay taxes, your fees, you pay your taxes, and then you reinvest, but it takes you have to go hunting again, so it takes you 6 months to get that capital redeployed. Well, it's not compounding. And
That's right.
here's the math we actually did because we have an evergreen fund that we're rolling out now, and we're loving this. Here's the math: if you have a 12% IRR on your and you do 5 sequential syndications, and you pay capital gains taxes, and so it's 12% return, and you do 5 of them. At the end of 20 years, you have $560,000, a 5.6x, 5.6 multiple. Not bad.
Nice.
And
Mhm.
because so you paid taxes 5 times in the middle of that.
Mhm.
If you have an evergreen fund that is tax efficient and that uses 1031s internally, okay, and you just compound same number, 12%, same $100,000, you get a 7.9% or 7.9x. So literally almost 40% more returns
Yeah, that's
because
a lot.
so even though you're paying more taxes, at the end, you compounded longer, right?
Mm.
The whole thing about compounding is you can't disturb your money. You gotta let it just grow. And so inside the fund, meanwhile, they're much more cash efficient, right? When they have cash flows, they can redeploy that, they can cross collateralize, they have lower reserves. So there's a whole lot of reasons
Yeah.
that they're superior.
It's like cooking potato bread. You can't open that oven or it's gonna deflate. You gotta let it rise. You gotta leave it alone and trust it.
Bob, man, our mom makes this potato bread
So
and
good.
it's
Whoa.
like crack, man.
Oh,
It
it's so good.
is you toast that
I'm,
and
I'm hungry
you've
now.
totally deranged or derailed my thinking. Um,
Okay, yeah.
go ahead.
Uh, um, well, if you've got something on that,
Well, I was gonna shift gears.
okay, let me shift gears.
Okay.
At a high level, because this is what I'm curious about. Where does capital raising break down the most? Right? Because like going back, you're ready for an answer, I guess. But going back, you said when you're first pitching deals, you got 50 butts and seats. You reached out to someone to help you get those butts and seats? Is that right?
Right. Yeah, a firm that did that.
A firm that did that. Okay, so that's what got me thinking about this. Go ahead and answer the question. At a high level, where does capital raising break down the most?
Yeah, honestly, it's trust.
Mm,
It's trust. And so, we've been in this capital raising business, like I said, for almost 15 years now, going on 15 years, and we just went to the big real estate conference called Best Ever, and they're down. Their registrations are down 75%.
mm,
This year, nobody's raising capital except us. We literally doubled last year what we raised in 25 compared to what we raised in 24. We raised
nice.
Yeah, that's great.
$150 million in equity. Um,
Oof.
and 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 had no problem doing it whatsoever. It's because of an execution focus, and we've always focused on execution, and boy, it starts to pay dividends after a while. People you just get a reputation, and all of a
Mm,
sudden when now we're standing out. So the tide's gone out, and you can see all the garbage, but you can also see who's standing and who's doing a good job, and so it's kind of honestly, it's kind of set us apart,
yeah.
and not something we expected or thought about happening, but it's happened,
So,
just because we've had an execution focus.
so are most operators not like good at raising capital?
Most are not. You
Yeah.
do have some that are really good promoters. I could name some names, I'll resist, who have face planted and have massive, massive losses in their portfolio, and they're papering it over and covering it over and raising an enormous, millions and millions and tens of millions of dollars, in the face of that because they're such good promoters.
Yeah.
And that's I just wanna unmask all these guys, honestly, because they're hurting people, and
Yep.
they should stop. But there are people who are just really good promoters, but most people are not that. Most people are having a lot of trouble, right, raising
Oh man,
capital
I
right
want to hear
now.
some names. I want to hear some names, Bob. All we got to do is say allegedly, and then we're good. You just have to say allegedly, and
Let me ask you a different question. You work with your son Ben
Yeah.
every day. My middle son is named Ben as well,
Uh,
the son of my right arm,
Mhm.
mm,
and he actually just graduated boot camp, Marine
wow.
Corps boot camp, and made it to MP school in Missouri just a
Military.
Oh, how
couple of days ago.
impressive.
Yeah.
Yeah, Fort Leonard Wood. So anyway, what's it like working with your boy? Like you work with him every day. You wrote a book together. You do a podcast together. What's it like working with him? And what do you two disagree about?
Gosh, it,
Like,
it
how's he
is.
make you sharper?
Oh, it is such a dream. It is such a dream. It's just so motivating to me. Here, I'm 65 years old, and I just got plenty of get up and go. And one of the reasons is it's just in such good hands with him. And the fear was it took me a lot to convince him to come on board because he just
Right.
had heard, all the horror stories, and I'm trying to recruit the kid because he was a real talent at the time. He was a banker by background and was a kind of a rocket ship banker, and I tried to recruit him in, and he was just very, very cautious, but it's been nothing but a good story, and honestly, we really don't disagree, anymore, and really didn't. I mean, even though I'm very much a type A person, he's got a strong will as well, but we've got our roles, right? We've got our areas of expertise. And so the latest fund, we've just spent 9 months arguing about this fund, but that's more iron sharpening iron, right?
Right. Yeah, yeah.
That's more he's got one perspective, I've got another, and I would argue my point, and it just makes us better. And we've come up with this incredible design because of that. So I think it's not disagreements, it's more different perspectives that we are synthesizing. And he's got so much more experience that I have in some areas. I've got a lot of history that he doesn't have, and so as long as we stay in our lanes, and I think it's hard. I think it's on the dad to make room for your kid, right? So no one wants to be the kid who's held down, right? And but as a dad, do I want to hold my kid down? Hell no.
No.
I want him to soar. I want him to surpass me in every way. I don't need to be smarter. I don't need to be more talented. I don't need to be better. I'm happy for him to shine, and I think that's the key, right? Is to, if there's insecurities and ego, then you have a problem.
Yeah,
And
and you see a lot of horror stories out there. I worked with our dad for many years, in this business, and my from the son's perspective, I remember thinking, uh, "Man, could I be good at this commercial real estate thing? Would I like it?" And and there's a big risk going to work with your dad.
Mm.
Like,
right.
I'm the 3rd generation of this company. Am I the one that's gonna screw it up, right? Or, um is it not gonna work? Is it gonna harm my relationship
Mm.
with our dad? I had all those questions going in, but ended up doing it anyway, and to your point, he wanted me to be more successful than him. Like, he didn't
That's the
have the
key.
ego where he was trying to make sure, and I had this deep desire to prove that I wasn't getting everything handed to me,
Yeah.
Mhm.
you know? And so I worked really hard. Like, I felt this burden to prove myself. Now I feel the burden to make it available to the 4th generation
Yeah.
Yeah.
or the 5th, and not be the one that screws it up, but I love hearing about that because
You know,
sometimes it goes really bad. Um,
I think my son would say the same thing that his concern was, you know sorry, I just blanked. What did you say? Your big
like, would I like it? Would I be good at it? Would it harm my relationship with our dad if I worked with
Oh,
him?
and and
Would I
and
be a
and the
disappointment?
proving yourself, you wanna prove it was earned, he would absolutely
Yep.
say that. How is this not nepotism, right? So we've got
Mm.
this staff of we got a large staff, so, yeah, the guy with the right last name is the one
Yep.
who gets the opportunity, and that's a real risk, and you gotta manage that, but one of the things that happened, so we hired him, he was not a partner or a senior executive even. We just hired him to raise capital, and I had 2 other partners at the time, so or 4 sorry, yeah, 2 other partners, and so he had to prove himself, and literally the partners all made him a partner, right? So he did and I'm like, "Hey, I'm going to bat for you, but I'm 1 vote," so
Sure.
he had to prove himself, but he did,
Is
and
there
so
is there anything, like, right off the top of your head that you can think of that he taught you about investing?
oh gosh, I mean, that would how long do you have? I mean, he's
Oh,
a
man, we
commercial
got
underwriter. He was a banker. So he is way more sophisticated underwriting than me, way more sophisticated at measuring risk. Way better strategist. So I'm more of a blunt instrument, in my leadership style. I'm more of an execution guy. Tell me what mountain you want moved and I'll move and tell me where you want it, and I'll do that for you, and I'll just get the big enough bulldozer and plow over everything, right? And
so you're
he is an absolute genius strategist. So he can't even do a tactic if he doesn't have a strategy. And so he's thinking the big picture. Wait, where's the market going? What are the competitors doing? What does the market want? These kind of things. How do we construct something that's beautiful, that's perfect? So that's the way he's thinking, and I just don't have the patience or the brain for that.
Yeah.
so
Like
it
I said,
sounds like
I'm just a blunt. So he is
yeah,
way, way, way better. He studies leadership. Like he's always reading the next leadership book, the next scaling book, the next something. And again, I'm reading the next history book and science book and quant book. So leadership is like leadership. It doesn't. I like it, but I just don't invest that much in it, where he's investing everything to be a better leader. So all these things,
Mm.
he's surpassing me at just every level.
Puts a big smile on my face to
Yeah, that's
hear a
great.
dad talk about his boy like that. Sounds
That's
like
right.
you're a broadsword and he's more of a scalpel.
Yeah, yeah.
Yep.
Yeah.
He's a better leader. He's a better leader. I'm, I'm better, but I used to, leave a lot of like damage behind me. you know? He doesn't. He doesn't have, you know, damage, where people become speed bumps. And
Yeah.
I mean, that was a long time ago. I haven't done that in years, but that's who I was. And he's just so much better of a
Yeah.
leader.
Yeah.
And
Um, for the sake of your other kids, because I heard you got a daughter, you've got the son that you work with, and do you have 3 kids?
I've got 4 kids.
4 kids, right? You know, at the risk of the one we're talking about being viewed as the favorite, what do you like about the other ones?
Yeah, great point. And how long do you have?
Jimmy
I could brag
asking
about
as the other one
I'm
sometimes.
asking as the middle of 6.
yeah, I could brag about them forever. My
Yeah,
daughter
sure.
runs her own marketing agency. She has been
Oh,
doing SEO for 15 years, is now one of the leaders in GEO, generative engine optimization, how to be
nice.
found with AI. And she's I mean, Meta is a customer. She is rocking it out. Absolutely genius little thing, super smart, and I just proud as punch. My third is an engineer, and he's a coder, and he writes code that sits on devices, embedded code, and he's a level 10 musician, and just that he's the tall, skinny, funny version of Ben, so he's like super comedian, comedic, and everything is fun, and every day is a joy, right? It's what and then my
Yeah.
youngest is a world-class, geologist, so he worked
Oh, wow.
for one of the largest gold miners in the country, and was actually credited his team was credited with making the largest gold discovery in the last 40 years in North America, and,
Incredible.
Wow.
so I got some super high functioning kids, and they're
Me
all
too.
married, and they all have kids, and, having a great marriage is awesome, and
Oh,
they all
man.
have great marriages, they're all super happy, and they're great dads, so I don't know how I won the lottery with these
I
kids.
I think I think you wrote the wrong book. You should
I know,
you're
yeah.
acting like a
I
billionaire.
think my wife needs to write a
Right?
book, reality, so
I
Well,
like it.
to your
So
point though, that's the thing that keeps me up at night about my kids
mm,
is that they'll marry the wrong person.
yeah.
And man, I got a lot of confidence and I love what I see in my 3 kids.
mm.
Mm.
And 2 of them look like they have someone special in their lives,
Ooh,
and my wife and I like them. So far
You know how you can be the best influence on that? Is have the best marriage ever.
yeah.
And then your kids will see that and go, "I know what I want because I have seen it
Yep.
modeled," right?
Yeah.
Yep,
So a lot of people have the opposite, right? They know what they don't
yeah.
want,
You're
and that's
right.
Right.
horrible because how many mistakes can you make if you only know what you don't want? But
Right.
if you know
Mm.
what you want, it's not you can really nail it. I mean, my daughter got married late, and it took her a long time, to find her guy, and she said, "Dad, I'm satisfied. I'm ready to wait. I'm not gonna settle because of my brothers. I know there are men who are amazing and godly and ambitious and all the above, and that's what I want." And she was willing to wait because of her brothers. So I think
That's really cool.
modeling this is the right thing, to be the best husband you can be and your wife the best wife, and that's the best way to give your kids a great future.
Yeah,
And
that's a great way to put that. We had that example. Our folks have a great marriage. They've been married over 50 years.
wow. Yeah.
Both Timmy and I have been blessed with incredible
Yeah.
wives and
Yeah.
and yeah.
41.
In fact, our last sibling
41, you
Oh,
41.
yeah.
that's amazing.
Yeah,
Yeah.
congratulations. Our last sibling got married 2
Just
weeks ago?
yeah, 2 weeks ago.
2
That's
weeks
right.
ago, we were in Austin, Texas. I actually got to perform my first wedding.
Yeah,
Oh,
that was
wow.
great.
How
You did a
fun.
great
That
job.
was a ton of fun. I've never done anything like that before, but it was cool. So, yeah, all of
Yeah,
us are married.
that was amazing. Um, I'm gonna circle back to, capital raising. Um, there's no good segue for this. So, if you could build a system a capital raising system, like the ideal one, maybe you already did, but if you could build a perfect capital raising system, what would it look like?
Well, and I think we have done it, and I think you should probably talk to my son Ben because he's the one that did it, and he's the genius. When I hired him, we had raised $10 million total in our entire history.
Mm.
He's 40x'd us.
Whew.
Um, yeah. But the first thing he did is he said we have to build a brand. He said the number one issue we have is trust. How do you get people to trust? Is
Mm.
someone going to Google something? Going to find you on a website and they're going to mail a check, $100,000 check? It doesn't happen.
Right.
So he started the whole thing about building trust and building a brand, and trust partly comes from testimonials and from execution. So it has have an execution focus. We really are we're not promoters primarily, although we've become pretty good promoters. We are primarily about execution, and we have a very sophisticated back office, very sophisticated delivery mechanisms for our investments, and underwriting mechanisms, and growth mechanisms, et cetera. Very, very sophisticated, and that's been our focus for 15 years. It's being steady and being execution. I think that's the key, and then it's building trust out there is really it. And for us, a lot of people have one thing, right? I don't want to have A when you want to buy B, C, and D. What if I don't want to sell just bananas when people are looking for a salad, right? So I want to sell the salad making. So that's why we have alternatives in real estate, in
Mm.
private credit, in natural resources. And so we have a broad spectrum. So we always have something that someone can buy. I can't I An investor, it wouldn't make sense for them to tell me no, right, as much because I've got something that fits them. You follow me? I'm
Yeah.
always raising for something that they need.
Yeah. Where does how many teams out there do you think are sitting on good deals, but they can't find the capital or they can't get them funded?
Honestly, I don't think there's that many. Um, I mean, I remember the pain of those early days where we were there. I felt like we had the corner on the market of this distressed debt. We know how to buy distressed debt and fix it and make gobs of money, and we could not raise money for this for the life of us.
Yeah.
But honestly, so we right now with our private credit fund, we're underwriting between 50 and 100 deals per quarter that we look at. So we have a huge amount of deal flow. And honestly, there's just, there's it's a only the top few percent are things we pay any semblance of attention to. So we see a lot of deals, and there's a lot of bad deals out there, right? A lot of
Yeah.
marginal deals. So,
That's right.
I
The-
and the truth is, and especially in real estate, not a lot of things are penciling right now. There's a lot of things that don't pencil right now.
Sure.
Right.
Well, along those lines, and I've really just got two questions. I don't know. Are you good on time,
I'm good.
or do you have? Okay. What you do an annual economic forecast every year? I
Yes.
read. What would you say your most contrarian call is for the rest of 2026? And I'd love it if it was in that CRE. Like we have a
Mm.
CRE audience here, so like what's something maybe that most of us hadn't thought about?
All right. Well, I did call in February a bottom in 3 markets. I called bottom in multifamily, I called a bottom in industrial, and I called a bottom in retail, real estate. So we'll see if that's right, but I did call the bottom in 2013 in the housing market. So it's a little bit of a risky call, but I believe we've seen the bottom, and I believe we're going to see it climb. I called for inflation to begin softening for several reasons, but that was before the energy crisis. So we'll see if that you know goes up, and I called for I said between 3 and 4 cuts this year. And again, that was before the crisis. So I may this may be my off year. So we'll see.
Ah,
Yeah.
well, and this is my final question. I don't know how much
Sure.
left you have, but
No, the only thing I wanted to say before you move on is calling the bottom sounds like a feature on Grinder.
I was trying to I was trying to ask my next question before you took advantage
Yeah,
of
go ahead. Go
him
ahead.
teeing that up.
Some people will get that. Yeah.
Uh-uh.
Okay.
What if you could make one investment for the next 10 years and just couldn't touch it, where would you what would you do? Where would you go based on
100%,
what you know right now?
100% natural gas, producing
Well,
natural gas. So we're buying producing oil fields, oil and gas fields right now. We're buying them, believe it or not, at a 15 cap. They're cheap as dirt.
Wow.
And natural gas, so it's the way I wanna play the AI boom, right? So if you look at AI, the energy needs we're gonna need to about double the amount of energy in just 5 years.
mm,
Electricity, there's one way to do it, one. It's natural gas powered, combined cycle turbines. That's the only way that is gonna deliver the electricity that we need. And by the way, there's also a breakthrough in battery technology. If you look at there's now a thing called solid state batteries that are just getting ready to come out. They're better than lithium ion. They have twice the power density of lithium ion and instantaneous charging and no
Oh,
limit on number of cycles. It's gonna make automobiles, EVs real. It's gonna make over-the-road trucking real. It's gonna make heavy equipment real. It's gonna make box trucking real. It's gonna make air taxis real, and all of which require electricity. The way to play it is natural gas, right? I mean, I was part of the dot-com boom, and you remember so you wanna play the internet, you remember the first company out there in the internet space? AOL, America
right.
Online. Netcom, do you remember Netcom?
I don't remember Netcom. I remember.
Netcom, they were the big ISP, you remember the first social media company? MySpace.
Oh, yeah.
MySpace. Oh yeah, I remember
Where
that.
are they? You remember the first search engine? Yahoo.
Yahoo.
They're all
Yeah.
so if you think you're gonna pick the winners in the IABOM, good luck. I'm gonna sell Levi's to the gold miners, right? And the Levi's are natural gas. So my number one play is buy natural gas by producing natural gas fields, which we're doing. And it's a generational investment. It's just I just think so we've seen here's the other thing. We've seen investment in exploration and development globally has dropped 55% since 2015. And so the world is underinvested in oil and gas exploration, and they're about to pay for it.
What I've been hearing, I don't mean to derail this or chase a rabbit down a hole, but I would love your short take on this. What I hear is we need more nuclear. Nucu I can't say it right. And
Nuclear.
I
It's
say it
called
like,
nuclear.
George W. or something, but,
Nuclear. We
uh
need some nuclear.
right.
Yeah. You gotta smoke them out of their caves.
But but it takes so long, and there's so much fear out there that I don't think is justified, but, you know, is that why natural gas is because it's readily available right now? Like, for the
Yes.
longest time, it was just a natural byproduct, and they were just burning it off because they couldn't do anything with it.
Right, they're flaring it. Yeah. Yeah,
Right.
so natural gas it creates 50% less carbon, 60% less carbon than coal to produce the same
Right.
amount of energy. Um, and yeah, you can buy a natural gas turbine, a combined cycle turbine. They're incredibly efficient and literally spin up a power source in weeks. Although there is a pretty big backlog right now of turbines. They have like a 2-year backlog for natural gas turbines right now. There's actually some of these new data centers they're taking old jets. They're buying the like gray boneyard jets. They're taking the engines, they're mounting them and putting generators on them
Wow.
and getting them to run on natural gas. But to answer your question about nuclear, there's a lot of talk about nuclear and these small modular reactors and et cetera. But they are at minimum 10 years from the very first prototypes. They're really don't and the Nuclear Regulatory Commission, the NRC, they haven't permitted a new nuclear power plant since the 1960s. Okay.
Mm.
Their job is to make sure nothing gets permitted. That's been their job. So they need to be retrained how to permit something. They don't know how to, they only know to stamp denied, denied, denied. They don't know anything else except denied. So they're trying to figure out how to do it. And I do think nuclear is going to be a thing, but it's probably going to be pioneered in Japan and in Europe because Europe, you realize, America is the world's largest oil and gas producer right now. We're the world's
Mm.
largest. Japan
Right.
doesn't have any. Europe doesn't have any, and they're dying. They're dead. without this. So they're probably going to pioneer these things. And there's some French technology and other technologies they're actually more advanced than any US based technology. So we'll see that, but it's 10 years out. We're just not seeing these. They're trying to restart these old plants, right?
Mm-hmm.
And all this needs land, right? Like to create all this natural, like, I'm just thinking with commercial real estate, buying up land. Anyway, you all can,
No,
you
I mean,
can figure
producing
that
oil
out.
and gas doesn't need land.
oh,
You just need
really,
mineral rights or
right.
gotcha.
something like that.
So,
Yeah.
I don't. What do I know? The only natural gas I've invested in is this little guy.
Uh-huh.
Mm-hmm.
Yeah.
A little
Okay.
brain fart.
All right.
Well, on the opposite side of that, what's one thing you would never do with your money?
Invest in my brother-in-law's deal.
Now, I got to ask, is that sort of a
Metaphorically speaking.
yeah, metaphor? Are you talking about a specific
Yeah,
brother-in-law?
no.
That's a,
Yeah.
That was perfect. That was perfect.
uh,
Bob, thank you so much for coming on. Let us know where they can listen to your podcast, name of it,
buy your book
and buy your
all that.
book.
Yep.
Investlikeabillionaire.org. And you can get the book there. And that's also a jump off to our podcast.
Awesome. Anything else you want to plug?
Yeah, if somebody's listened to you for the last hour and is thinking, man, sounds like somebody I want to invest with, where would they go?
AspenFunds.us.
Aspen Funds.
We got a lot of accredited investor listeners. Like
We do.
Yeah. Great. Well, Bob, thank you so much.
Yeah, this has been great. Super
It's
interesting.
been wonderful. Wonderful.
And fantastic to meet you and hope to talk to you again. Maybe we'll have to get your son, Ben, on here.
Right.
Yeah,
Absolutely.
that'd be great. It really was incredible. Thank you so much.
Yep.
All right.
Thanks for listening to Commercial Real Estate. Thanks for listening to Commercially Speaking. You can follow us on all social media at Commercially Speaking, on X at ComSpeakPod. If you have not yet gotten an executive assistant, visit our friends at superpowershq.com/commercially speaking. For those in the back, that's superpowershq.com/commercially speaking. Get your time back. Eliminate the suck. It's changed Bo's life. In mine, just in the vicinity of being around it. So go get yours today. We have a newsletter, subscribe.wgbaron.com. That's subscribe.wgbaron.com.
Love you, brother.
Love you too, brother. Bye, Alice.
Bye, Alice.
Bye, Bridget.
Bye, Bridget.
Woohoo.